a hurricane every single day in the stock market, and this week is no different. In this episode of Market Boss, we'll be talking to you about what our thoughts are, what we're planning to do, how we're planning to do, like how we're planning to analyze it, what are our expectations before, and what we're expecting as as Jerome speaks. In about 45 minutes, he should be speaking, and we should be getting the Fed statement very, very soon. Again, it's an interesting day. If you have any questions, don't be afraid to ask them in the chat. We're more than happy to try to answer any questions you have. Beforehand, we'll be having commentary as Jerome speaks. We'll see what happens, but I don't know. I'm kind of like having some. I don't know if it's just like hopium here, but I'm thinking potentially it could be good. Potentially it could be good. Cool. Sax in the chat. Welcome, everybody. We have 12 people watching, which is like for a Fed meeting. This is amazing numbers. And usually it's like me, myself, and I watching this, and with Dimitris and Mimi. But it seems that there's a lot of appetite for this meeting. Everybody's waiting. Everybody's trying to figure out whether we sell this highs or we continue to go lower. So, or we continue to go higher from here, right? So, will he be the Grinch? We're going to find out in this episode. Wow. My goodness. Yes. Welcome to another episode of Market Buzz. Don't forget to hit the like and subscribe. I don't know all the things we are going live tomorrow. Every Thursday, we have live streams. So don't forget to join the community. We just talk about markets and see if we can make some money. All right.
Oh, I've had so much coffee. It's nearly 2 a.m. for me. So and suddenly, I don't know if it's the coffee, but I'm anxious, nervous, excited at the same time. And I mean, we've been speaking for like a few hours already, and I still look. My thoughts are volatility throughout, but I'm bullish going into this meeting post FOMC. Yeah,
it's super interesting because every single time he goes, he goes on the podium and he says, "Good afternoon." Markets just start plummeting. So it's definitely going to be a good one. But we're going to walk you through what we're expecting, what we see, because this is not just any sort of meeting. We also get the summary of economic projections, so we get a little bit more clarity what the members of the FOMC are thinking, the voting members at least. And this gives us a little bit of clarity for the year. Obviously, we're going to get the 2026 idea of what the members think the rates are going to be, what inflation is going to be, what unemployment is going to be. So it's very important numbers to kind of pay attention to and kind of keep in mind whenever we get future decisions. I think the next Fed meeting is going to be on January 28th. It's another date to watch out because on January 30, we get the shutdown decisions once again. So yeah, we're here with Dimitris, Mimi, and Nestor, popular investors on eToro. Check out our portfolios down below. All right, Dimitris, what are your thoughts on this?
I'm feeling bullish going into today. Obviously, today, anything can happen. Okay, the J. Powell can get on the podium, can give his statement. The market goes up. Then the Q&A, they ask him a trick question, which is what they like to ask him, to put him in a position, ask him a hypothetical, and the way he answers, the market takes a dive for a minute or two. So how it goes today doesn't really matter as long as we get the cut. Get the cut. I don't care what the committee members are thinking, what they think about what's going to happen in a month or two. It's one meeting at a time. Let's get the cut today. And once we get the new data next month, the new CPI, the new PCE, unemployment, and all that, then we readjust expectations and we'll take it from there. I expect a hawkish cut, which means we get the cut, but without any promises for further cuts. That's keeping their options open in case they want to pause or cut more, not to promise anything. That's what the hawkish cut mean. And dovish cut, we say we're cutting now and we're cutting next meeting, or we're cutting in next meetings. I don't think we're going to go there. Other people call it insurance cut. You're cutting now just in case we get bad data and you don't want to fall behind, whatever you want to call it. But I expect the Santa Claus rally into the year end. and 2026 is a new reality. And when we get the next year, we're going to discuss what happens in the next year.
Yeah,
Yeah.
for sure.
Yeah. I'm on the same page with the Santa Claus rally as well. Well, I wouldn't say specifically equities, but like for equities, and that should also, help crypto. Sorry guys, it's like so late now. I'm just like trying to like form sentences, but yeah, no, I am on the same page as that, and I think it's really different to what happened last year. And so a reminder of what happened last year in the December FOMC, when I'm just specifically Bitcoin, is that we saw Bitcoin fall about 15% post FOMC. And it was very unexpected because Powell came out and insinuated that would be less cuts for 2025. And people didn't expect that. So it's different this time around because everything is just like the situation, the environment's all different. And we've just, ended QT. At some point, QE will start, but yeah, I just don't. I'm on the same page as a Santa Claus rally as well. Not financial advice, but it's different to last year. Different to last December.
Yeah. No, it's also interesting because the expectations are different too, right? Like one of the things that we can pay attention to is kind of like, what are the expectations? What is the market sort of waiting for? And right now we are expecting a cut. It's almost a guaranteed cut today. We're almost a 90% chance of a rate cut today. Interestingly enough, January only has 22%, right? And this is a sort of like gone between 25 and 20%, right? So we've seen sort of that sort of like range, right? By the way, Akshay has a question here. It's like, when will the meeting start? So the meeting starts within like 40 minutes, like 38 minutes around. Just so you know, but the statement will come out before that, right? So we're planning to go over the statement. We're planning to go over the summary of economic projections and sort of like get an analysis of how we look at this and what sort of analysis and research we do as we wait for the meeting, right? Obviously, markets are going to be volatile. They're going to move up and down. We're going to be showing them. I want to be showing the S&P 500 as this happens too.
By the meeting, he means the press conference.
I'm assuming. Yeah, I'm assuming. Yeah. But yeah, so yeah, right now we are expecting only, I think it's 3 cuts. Like we're only expecting 3 cuts for 2026, right? At least the market is, right? Obviously this can change as time goes by, and the fact is, in January, in the 18th of January, we're going to have 2 pieces of data that are very important. We're going to get the November data and the December data, right? Which we're expecting next week. So far, I mean, like I've kept an eye out on private data, and the private data is coming in a little bit weaker than expected. I think the market a while back was actually not expecting a cut, but we've slowly moved towards that sentiment, right? So it's like, I think we were like, even a month ago, we were sitting at 60%, and then that went down to like 30%, and then it shot back up, right? So it's like the market didn't really know how the Fed was going to act because of the fact that we were not getting any data. We just didn't know. But the Fed has ways to getting private data, private payrolls, all of these different sources of information, but it's always difficult, right? And you always want the government data, which tends to be a little bit more accurate, a little bit more sort of solid, or at least trustworthy, even though we know that they usually miss to the downside and they have to reevaluate and everything becomes even lower. So the numbers sometimes are buffered in a sense. So it's something definitely to be paying attention to right now. Again, we still don't know. We are expecting a 25 basis point cut, but again, they could go 50, they could go 0. This is just expectations of the market, right? But yeah, I mean, like even last time we had this summary of economic projections. So this is something that we're going to be looking at as well, is the dot plot, right? And last time, the end of 2025, the blue line is where the rate ended up being right now, which is 3.75. Well, it's actually here. I messed up that line. But yeah, and this was the 2026. So the dot plot is going to be interesting because it tells you where the members are thinking the rate is going to be in 2026. Wait, am I not streaming the right thing? No, I'm not.
No.
You know those expectations, what they expect a year out, they're always wrong, right?
Correct. Yeah, well, if they can't even get the inflation rate right? So it makes sense, right?
Any forecast they give where inflation will be and where rates will be are always so off. The inflation, they are always 2 years behind the inflation. We're supposed to be on neutral like 2 years ago. Not neutral, on target, sorry. 2 years ago. So you can't go by the forecast.
Yeah. No, the forecast is like, the thing is many people think that this is what's actually cemented in stone, but the reality is not that. The reality is that this is what they're thinking today. This is what, based on today and based on the data and based on the discussions they've had for the last couple of days, this is what they think should be the rate of policy, right? This is just one aspect of it, right? But this is the dot plot. This is each point represents each voting member and where they think those interest rates are going to be. The green ones is what I think they're going to be. I don't know. Like, I don't think we're going to see much change for 2026 until we get the data for November and December. And that's going to give a little bit more clarity. We're going to get the PCE data. We're going to get all of this data, which so far has been in line or a little bit lower than expected. So is unemployment deteriorating at a fast pace? I don't think so. But we are seeing some weakness in the labor market, even though in the last couple of days, we've seen that sort of step away, right? Or sort of dial back a little bit. So yeah, I mean, like, it's going to be tricky. We have the summary of economic projections. We'll go over that. We'll go over the statement, because I like the Nick Tamaria's way, which shows the old statement versus the new statement and what are the changes. Because every single little word, the whole market like leans on it very, very strongly. So it'll be interesting to see whether unemployment is the thing that's scaring markets, or whether it's either unemployment or inflation. Those are the two mandates. So we're going to be paying very close attention to that. We are about 2 minutes away from the data. Fun, interesting. This is what the market's waiting for.
Good times.
Indeed. So here, interestingly enough, I actually want to share the S&P 500 just to see how it will behave.
Mm-hmm.
Let's just do 1 minute so we can actually see the moves.
I will look at Bitcoin. My heart is racing. I don't know why. I mean, we spoke about this for hours. I'm like, I have an idea of how this will play out, but
what's this?
Hey.
So this is the S&P 500 on a minute basis. So whenever the statement comes out, you're going to see the algos trade this. So you're going to see the moves. Whether it's going to be red, whether it's going to be green, we don't know, right? But this is just the 1 minute. Adrian is in the chat.
Hey.
Let's go.
By the way, last week, it was the all-time record of people traveling on a single day in the United States. There were like 3 million people.
Data's out.
Let's
so
go.
Data's going to be coming out. The interest rate decision. Ooh.
Put it on the screen. Put it on the screen.
Let's have a look. Let me find it. I need to find. Oh, wait. Oh, no, there's still 1 minute. Sorry.
Wow.
I read it wrong. The nerves.
I'm good.
There's 1 minute. I read the 9 as a 0. My bad. Most people.
I sleep through this usually. I should be sleeping, actually. That's why I'm nervous.
All right. So let's have a look. We get the median rate forecast. Yeah, that one is going to be interesting. And then their expectations on GDP, inflation.
All those are going to be off, like, by a lot.
100%.
Those are just conversation statements.
For sure.
3, 2, 1. This one is real.
Let's go.
So yeah, it's a 25 basis point cut.
Okay.
Perfect.
Okay.
The U.S. federal budget balance. Wait, do we get also budget data? No. There we go.
Ooh.
The median rate forecast within 2 years is within line, so it's still the same. The next year is 3.375, so it hasn't moved. Market likes this. So you see this right here? There we go. Yeah. So that's been the minute. That's just the minute that it's been. And we are seeing some green on the S&P 500. So it seems like we are getting.
Yeah, crypto is rallying.
Yeah. Let me get the statement here in front of us. All right. let me get this statement out. So, right. Market likes this. Market likes this. Let's go to the moon. All right. So,
Too soon, not yet.
yeah, well, it's not because Powell has to speak still, right? We will
Yeah.
consider the extent and timing of additional adjustments. Only 125 basis point cut in 2026 is what the median says.
Okay, and I call portion on that. Yeah.
Oh, wow. We will buy 40 billion of treasury bills over the next 30 days. So they're going to be, so this is the balance sheet. This is the balance sheet run up that we were talking about before. All right, let me share this real quick.
You're gonna buy?
They're going to buy 40 billion in the next 30 days.
Okay.
All right, so let me show the statement here. Available indicators suggest that the economy activity has been expanded at a moderate pace. Job gains have slowed this year, and unemployment rate has edged up through September. More recent indicators are consistent with these developments. Inflation has moved up since earlier in the year and remains somewhat elevated. So you see, so those two things is like, it's kind of neutral in the sense, because it's like both unemployment has gone up and inflation has sort of stayed neutral. The commitment seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate and judges the downside risk to employment rose in recent months. This is important. It's important because I want to show you guys also like the difference between like the old one and the new one. I think this tells you that unemployment is still top goal because it's the thing that sort of like put before, but I could be wrong. In support of its goals and in light of the shift in the balance of risks, the committee decided to lower the target range of the federal funds by a 1/4 percentage point to 3.5 and 3 3/4 in considering the extent and timing of additional adjustments to the target for the federal fund. The committee will carefully assess incoming data, the evolving outlooks, data dependent. The committee is strongly committed to supporting the maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implication of incoming information for the economic outlook. The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on the labor market conditions, inflation pressures, and inflation expectations. Interestingly enough, inflation expectations from the Michigan report every week have come in lower and lower. So something very important to pay attention. And financial and international developments. The commitment judges the reserve balances have declined to ample levels and will initiate purchases of short-term treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. Bam. So that's the statement right there. Like that's the start of it. We'll have to see. Ooh. Okay, you can see. All right, I didn't get the Doppler right. I got the answer. I didn't get it right. Fed Merian is way lower, but funny enough, that's an interesting dot here. So let me stop sharing here real quick, and let me share the proper.
Powell doesn't speak yet. I think someone's asking for.
No, he hasn't spoken yet. So. No. Powell doesn't speak until 7:30. So there's still time.
Yeah.
2 minutes.
Yeah. We'll have him live in the episode. Don't worry.
Hey, Toby.
Toby's in the house.
Toby in the house.
We can definitely see the reversal. I definitely agree on that. And Adriana is saying we can see a reversal. And the thing is we are likely to see because any hawkish sentiment, like Powell tends to sort of go on the hawkish side. So here, let me show you here. This one here, which I really like. So this is from Nick Timirios from the Wall Street Journal. He's going to be speaking there. But yeah, the 40 billion is bullish, right? So they're giving us an idea of what they're planning to do with the balance sheet, which I think is bullish. But okay, so available indicators, blah, blah. So the unemployment rate has edged up, but remained low. That's gone. So the remained low is gone, right? So it's key, right? Like, it's like, why are they changing this? Is because like, this is where it matters, right? It's like, so they're paying attention to unemployment. This is in theory dovish if we continue to see weakness in the unemployment data. in considering the extent and timing of a, so you see, so here they're saying it's like we're going to be waiting to see whether we continue to increase. So this is where it becomes dodgy, right? So it's like this is data dependent. I mean, I don't know, it's like this is what I'm looking at here is like this goes again to the same thing that Jerome has been for the last little while, which is just we are data dependent. We're going to wait for the data, but so far we are scared that unemployment could continue to tick up and employment conditions could start to deteriorate. Ooh, Adrian is trading the markets. Adrian is trading. I was like, I took a trade. I mean, market seems to be liking this, right?
Yeah, it's a bit.
Yeah, it's a little bit, right? But it's like it's not much. But I'm green. Yeah, my portfolio is green. I keep saying the same thing. I would say that all day. It's like every time I'm green, I'm like market's up.
He has to get on the podium, and then you see if the market really.
Yeah. No, because all the questions are going to be interesting, right? Like how he answers, and he's likely going to turn hawkish. Like he's going to be like, "Hey, we're going to be data dependent. Don't pay too much attention to the summary of economic projections." Yeah. So this one is a big one. This one is a big one, right? So I think this is like, it's added liquidity to the market. This is like giving it to the U.S. government. The Fed is taking care of maybe Japan not being in the treasury bill auctions. But we'll see how much they can actually do it. This is to increase the balance sheet because it was even lower December 3rd. So something to pay attention to for sure. But yeah, 3 dissents. Galsby, Schmidt opposed the cut. Miran wanted a 50 basis point cut. The summary of 6 officials didn't vote in favor of a cut.
The crypto guy, Miran.
Yeah. He wants a big cut. He's looking for 50.
All crypto people want that, but that's just short term, not good. Short term. Probably get.
But yeah, I mean, so far, it's like market seems to be liking this. But again, we could reverse it really quickly.
When you say markets, you mean your portfolio likes it.
Yeah, I like it. So far it's great. Sell. Don't buy. Sell. All right, so let me have a look. Let me see. Let's see if it would be interesting to see what Trump said, because he's gonna say something, it for sure. Let me have a look at the 10 minutes.
Trump probably wanted like a 50.
Nah.
Yeah.
Market's liking it.
Last week he said buy stocks. Do you remember the last time he said that?
Did he?
Yeah, he did. Last week he said buy stocks.
So when he said buy stocks?
Then you buy Costco,
It's defensive. Defensive has come down. But I mean, it's not come down. It's just we're going risk on, it seems, right? Market seems to just be, hey, pump it.
Yeah.
But not too much. I mean, like we have to see. I mean, this will this will move, that's for sure. Even crypto's a little bit up, Nice. Let's go to the 10. Let's go to the 5. Nice. Let's go to the moon.
Where is the Russell?
Let's go. Russell 2000.
Russell 2000.
IWM, not bad. So microcaps are even liking this, right? All right, so let's go. Yeah, exactly. So that's the thing. That's very important. So we need to go to. All right, so news and events. No. Hello. Is it here? Yeah, there we go. I got it. Okay, so we get the. It's still not up. There we go. So let's get the PDF. So here we get, okay, so change in real GDP 1.7%. 2026 was 2. Let's go in. Is that better?
Yeah. Yeah, consider it.
It's up a little, okay, this potential. Welcome to the stream. Crypto's up a little bit from 2 minutes ago, 5 minutes ago, only a couple of minutes. It's just bounced a little bit. That's it. I'm not saying we're all-time highs. You know what I mean? We're not all-time highs, just a little bit. Just a little bit. Like my portfolio is 0.5% up. It's not all-time highs. All right. Lows. Okay, so September projections was 1.8. So they're expecting the economy to be better. You know, it's like even the economy was better than expected this time around. 2027 a bit better, and so we're longer run. We're seeing like economy will be better.
Yeah.
Yo, I am almost in profit on my Ethereum. Almost in profit on my Ethereum.
Strong. Yeah.
Yeah. So yeah, unemployment rate, they're expecting that. Well, their unemployment predictions are still the same, so we're not going to see any major changes. If that starts to change, we're going to be paying attention to that. This is the right data, right? December 10th. Yeah, because I've gotten it wrong before. So PCE, so they are expecting inflation to tick up a little bit, right? So actually to tick down.
No, it's going
My bad. Yeah. So they're expecting inflation to tick down a little bit. They were expecting 2.6, and now they're going to 2.4. And core, you see, they expected inflation to be higher than it was, and it's actually sitting at 2.9 and 3, and then 2.4 and 2.5. Right? So we are seeing, and then we get to that run rate of 2% in the long run. We'll see if that happens. So this is good, right? Like unemployment continues to be the same predictions, but we're seeing sort of that tick down in inflation. It's a dovish cut, man. It's a dovish cut. He's going to be hawkish in the call, but this is dovish, right? A little bit. Because the thing is like the fact that GDP is going up makes it neutral. I think it's a neutral cut so far, you know?
Okay, so what you just showed means nothing.
Yeah. It's prediction. Like, I mean, like, this is what they think. Yeah, I agree.
It's like 2 years into the future. Like next week could have like a crisis that wipes everything out. So projections are like good to have them, have an idea what is possible and what is likely. Most times it's very unlikely, but you can't make a decision today based on a forecast from 2 years from now. But the data are better than expected for this year, and I think what they expect one cut in 2026. That was what they said. One cut in 2026. I think it's going to be more than that.
I think so too. I think the median cut, but then the thing is it all matters on what the actual data is. You know, let's have a look at this and see if this is updated. It's been 13 minutes, probably not. This takes a while. 48 days. The timer resets. All right. You see? Yeah, this is not updated. The December is still at 90. It should have. Huh.
Do you expect a January cut? You guys expect the January cut?
I think so. I think we get it because I think the data is not going to come as pretty as we think for November and December.
Yeah.
As long as it's not too bad.
Yeah.
You know,
I believe we won't. Okay, so if they expect one cut, let's go by what they expect, one cut in 2026. So what? They're going to give us the first cut in January and that's it? That doesn't make sense.
No. We wouldn't. They're like, at least the probabilities we're expecting a cut by like June.
No, we're definitely going to get it by June. If Trump gets his guy in May, we absolutely getting a cut in June.
But he's just going to, when is the next one? Yeah, June. No, July. No, June. Sorry. So yeah, they're expecting June.
Why don't you think we'll get a cut in January, Dimitri?
No, I think they're gonna leave them for later in the year because if you're gonna get a cut in January, is you're working with the December data. December is at the holidays and like all the seasonality. You're not really getting even like in recessions, the December, the holidays, the spending is strong. So you're not making good decisions. You're not making decisions on accurate data because of the seasonality. So in my opinion, we're not getting one in January. because also you're starting the year like strong, like, okay, we're starting cutting first meeting of the year, and then you up the expectations for the rest of the year to get more, and that could get you into trouble with market expectations. So if I have to guess, I'm not saying I know. If I have to guess, we're not getting one in January, but we're gonna get more than expected. If the market expects 1 or 2, I will probably go with 3, but we're gonna get them later in the year, like we did this year.
Mm.
That doesn't mean the market doesn't rally. The market can rally.
How many? So you think we get 3 next year, or you just think like just more in general than
More of what they expect, because I think we're gonna get it down to neutral, and by neutral I mean down to the inflation rate. And the inflation rate is gonna go further down. Maybe not at the speed that we all want, but it's gonna go further down. And we are what, like 75 basis points above neutral right now,
Russell's all-time high, really?
something like that. So I think we're gonna get 3 more in 2026, and it's not unreasonable for rates to be in the mid twos.
Yeah.
Right? It's not like 0. We're not going back to 0. It has to have to have a good reason to get back to 0. We're not going to get it just for the fuck of it. So
No, like stuff has to break, right? Like
yeah,
we went to 0 and we stayed in 0 because the economic conditions were so like. When did we start heading to 0? 2009, right? Like it's like because we needed to stimulate. The economy was in a shambles.
the president wants rates to go lower, okay, and he can be very persuasive, or he can bully you into getting his rates down.
Yeah.
And so he's going to get the guy in there that is going to give him rates. Now you can tell me the Fed chair is just 1 vote, and that's the reality. It's 1 vote, and the committee votes, so they vote all together. And it takes some time for a Fed chair to get some influence on the board and direct them, like Jay Powell has some influence now on this board. But the president is going to put there people that they want to advance his agenda. That's what happens always. It was always been the case. I don't know why people think that this is just something new. Has been the case like forever. So the president wants lower rates for the housing market, so people can get houses like with lower mortgages, and that's how it's gonna go.
Yeah. No, I think like and again, like they're telling you we're data dependent. We are willing to take action, whatever the scares are.
You know what? If I was Jay Powell, I would say exactly the same thing. Data dependent, and keep my options open, and I pause if I have to pause, and cut if I have to cut.
Yeah. No, it's the truth.
That's true. Yeah.
By the way, when you guys write on the chat, it doesn't show on the real chat.
Oh, okay.
So you guys have to go to like this stream chat. It's weird.
Oh, right.
Yeah. It's weird. So that's why I'm like showing them.
By the way, I made another call at the beginning of the year. I don't know if you remember, Nestor, that I said the US is going to outperform Europe. Where
so
we
far,
are?
Yeah, I think you.
Where we are on that?
I think you're good.
At the time, the US was -5, and Europe was like +10.
Yeah. And then Europe has just lagged. Yeah.
That was a good call.
It was.
Didn't you say was it like China would be uninvestable, or was it Europe?
Yes, no. That was China, which kind of is in my opinion. Okay, the market has done well, but
it was so cheap. It was so cheap.
To me, it's uninvestable still. But that's my taste on investing market. Like for me, the rest of the world is uninvestable. Like Canada is just like a ski resort. Okay, I can go on and on. For me,
Nestor's feelings.
What happened?
He's not listening. He's talking about Canada, so he's gonna hurt your feelings.
Canada's great. Canada's doing great. I thought they were gonna. Yeah, Canada's doing great. I think they finally they bumped down unemployment. So yeah, Canada is healing from the American aggressiveness. I like Canada. Canada's nice. Canada's like a little cheat sheet because when the United States starts doing bad, Canada does awful. But if Canada's doing okay, America is okay.
Oh, that's true.
It's like I don't know. Like it goes back to that saying: whenever America coughs, the rest of the world catches a cold.
Mm-hmm.
So I like to pay attention to how everybody else is doing, and obviously because they were giving data, it was actually useful to actually just keep an eye out on it because we were missing data from everywhere else. We actually saw inflation come down in Europe. We actually saw like they're holding rates steady. So
Yeah, but Europe started the cutting cycle ahead of the United States. The
yes,
Fed was
correct.
okay, so you have to take that into consideration. Europe
Yeah.
was like three or four cuts ahead of the US, so it's normal for Europe to pause, and then the US to follow, which was unusual because it's usually the Fed that cuts first and the rest follow. This time was the ECB. ECB started first.
Oh, I'm so sorry.
For what?
What happened?
Oh, no. Somebody's wanting subtitles in Italian. It's not available.
In Italian.
Yeah, it's gonna be live after, but the thing is just like I don't know how to like mess around with it on here. Like it's like, yeah, I'm sure the live caption would be on if we did it up from OBS, we could do live captions, but they will be after.
We'll figure it out. I'm so sorry.
Yes, we'll give you a summary, and then that one will have it.
Yeah.
But market seems to like it so far. I mean, we're higher than we were a couple of minutes ago. So
yeah.
Do you have any key stocks or crypto that they're like your indicators when the market likes something?
Well, the thing, I'm in an interest rate sensitive stock. I'm in nail, which is a three times leverage ETF on home builders, and home builders tend to move when there's signs and hopes that easy monetary policy could come. So far, it's had one of the craziest moves, the home builders, in the last couple of weeks. So usually they sell off after the interest rate decision because we start becoming a little bit more sort of hawkish. The question will be what happens next week, right? So we still have a bunch of data that we have to pay attention to. We have a bunch of data we have to pay attention to. We have unemployment data and inflation data on the 18th and the 18th, I believe, of December. So next week.
Yeah.
Right. And then no, but that's CPI. So that's inflation data that we get next week. And then when do we get the unemployment data? I have to do. Well, I'll come up more prepared for tomorrow's live stream. By the way, we live stream every Thursday, unless there's major events. So don't forget to hit the like and subscribe.
Japan as well. I know. Yeah, I don't know why Melly is down. Actually, I was looking at that. Toby, why is Melly down?
Tuesday, December 16th is the employment report, unemployment rate.
16, 18.
No, that.
So next week's gonna be fire.
Tuesday.
Yeah.
Fire.
Yeah.
Yeah, market
more nerve-wracking than today, I reckon.
The 18th is a consumer price index, CPI, and all that. Okay.
So yes, so the 16th and the 18th, we have the 16th, we have employment data, and then on the 18th, we have CPI.
Yeah. And you want to assume that the Fed knows a little bit about what? No, they don't know shit.
You remember it was at two meetings ago that they literally were like, oh, like we're gonna be a little bit more, and then the data came in horribly, and it was like
in July. It was in July.
It was crazy. I'm like, just give him the numbers. Give him the numbers before he's about to crash. Tell him there is a car there. Like, I don't mind if he knows. Like, just tell him, Holy, it was insane. It was insane. Like, everybody thought, oh, yeah, like he definitely knows something, and the data comes out and it's like, no, he doesn't know nothing. Like he gets the data, like he has to press F5, refresh the website.
You know what? It's a pretty sensitive information to know those numbers. And if they tell the Fed, someone's going to leak it,
Yeah.
and
It
you
could.
can make a lot of money betting with those numbers, like knowing before. So the government releasing them, even though they weren't entirely true last year, they were like faking the numbers a little bit. Like just announce them like for all of us at the same time. Maybe it's a good thing.
All right, let me check something out real quick here.
You're going live now. Can you put the screen on?
Yeah.
Powell?
No, I'm coming. I'm doing it. Share audio.
Any minute now.
Hmm.
Should I put a whiskey on?
Yeah.
I'm
why not?
actually kind of scared to do
Oh.
this because I
Why?
don't know if they're gonna hear you guys as well.
Can you put subtitles on the?
Let me have a look. I wonder, like, somebody tell me if you can hear Mimi twice.
I can.
We have
mute
20
myself.
people watching. Insane. It's crazy that this many people want to watch the FOMC.
Or maybe they want to watch us.
Of course.
Of course. Well, it's the first live that Ness is
FOMC
not
meeting.
by himself. Yeah.
Yeah, I have friends.
Like, who do you talk to?
And
You don't
put the CNBC link.
CNBC.
The
link?
CNBC?
Yeah.
You want the CNBC?
Do you know what CNBC stands for?
Tell me.
What is this a test?
I found out yesterday.
What is
No.
it? What is it?
So it's Consumer News Business Channel.
Wow.
Wow.
I did not know until yesterday.
Wow. Did not know that.
I did not know that either.
Consumer channel.
Potential is at every live. MVP.
Nice.
Thank you for the support. We appreciate it.
Thank you.
All right. Now I wonder, like, I'm not sure because I can do the tab.
I'm gonna be back.
I want to listen though. I want to listen exactly what he said.
We can hear it. Like, this is the thing is this is gonna be more live than CNBC, but we can watch it on CNBC. I just don't know if we can hear it twice. You know what I mean?
No, I think we hear it twice. Maybe they're not going to hear
No,
us.
the live stream. Because the thing is like, CNBC.
Can you try something else?
Yeah, it's gonna be. I'll find it. CNBC doesn't have a live. There's no way. Here we go.
Yeah, they have a live.
They're not live. They're waiting. So they're about to go live. They'll go live in a minute. So we're about to go live here. We are 30 seconds away from Jerome Powell. Good afternoon.
And then watch the market. Good afternoon. And then the market goes down.
Yeah. By the way, do let me know. This is for the chat. Let me know if there's an issue with the audio. If you can hear us twice, let me know because I can make some changes and make it not happen. I can just do it. And you know what? I can do it now.
Let me get
a whiskey.
Whoa.
Yeah.
What happened?
I'm going to put some in my coffee. I'm going to make an Irish coffee.
Nice. Oh man, it's 2:30 a.m. for me. I'm not going to sleep till 4 a.m. or something. It's all right.
CNBC is not live. CNBC is not live.
Oh my god. What?
Wait.
I might as well move to the UK or Europe somewhere because I'm not even sleeping properly anymore because of you guys.
No, it's not on yet. Maybe it's on. Yeah, put the volume on.
Can you hear it?
No.
No.
Try Bloomberg.
Give me a second.
Okay.
An ample supply of reserves over time,
Can you hear it?
thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5% to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right. The printer.
Thank you, Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks.
Yeah.
That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
Yeah, they're on
And
hold.
if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
So that's no recession
Thank you,
fears,
Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing, but that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see. And we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And, we come together and we reach a place where we can make a decision. We made a decision today. We had, 9 out of 12 supported it. So fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out. And I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see, and we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do 2 things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
He's giving me a good question.
Nick Timmerosa, The Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, The committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
He's neutral, which we thought we were going to be a hawkish guy.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000. So that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall, that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part that's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get three questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut three times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two goals. And so that's just unique in my time at the Fed. And I think going back a long ways, we haven't had that in our framework. Our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral, because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut three times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Like, he's not saying he's not going to cut.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, it takes, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is, but call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this, and after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant there. And the president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
He doesn't care, dude. He's so great.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got it when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal. And our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money. And we're going to need to have some years where real compensation is higher. It's positive, significantly positive. So nominal wages are higher than inflation for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers is also going way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low twos, right? So it's really tariffs that's causing the most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both. And I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month. So 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers, and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. There's depth. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Yeah, you can.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy? And what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a, price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low low rate mortgages from the pandemic period, and they kept refinancing and got the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem. And really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address, a secular housing shortage, a structural housing shortage.
Chris.
Okay.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's, I don't have time to think about the bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Let's go.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Let's go. That was new. That was nice.
Hey.
That was nice.
That was good.
The Q&A, he killed it. He was like on point. He was like, sometimes he was like, he's thinking. No, this time he was on point. A bit more neutral than I expected.
Yeah.
I wouldn't go as far to call it dovish.
You know what makes me think dovish? The liquidity input. Like that's what it makes me think it's like potentially like neutral a little bit dovish, because they're like we didn't expect the 40 billion.
Yes. Well, it's dovish based on the fact that everyone was expecting him to be hawkish. Like that was good. That was good.
But what were your thoughts, Dimitri? Sorry, I cut you. I cut you.
Okay, so I don't pay too much attention to the forecast and the growth and the unemployment because they don't know. You're just speculating what it's going to be next year. I expected the cut, and I forecasted the cut. Like I was probably the only one saying 2 months ago that we're getting a cut this meeting. But I expected it to be more reserved, try not to promise anything. And he did not promise anything, but his tone was a bit more neutral. Okay. Yeah. He was talking to the markets, and I like that. I think we are back on schedule. I think the market rallies end of the year. I think crypto has. I mean, if crypto doesn't rallies now, it's now or never. QT stop. We got another cut. We're getting the liquidity. It's the end of the year, so it's now or never.
Yeah.
No.
But the thing is it's just starting, because he said for the next couple of months we plan to be spending, like we plan to increase the balance sheet a little bit faster than previously anticipated, just to make sure that the liquidity is there. Which I think I like, you know what I mean? It's like, look, it's better. 40 billion, the start. that buys treasuries, that gives liquidity to the U.S. government. We see the U.S. government back on track. They're going to be spending. So this is good. This is good news. This
The
is good
physical
data.
policy is going to be the physical policy is also going to help. And so what's the risk? So what's the risk between now and the next meeting? Is the data that we're going to get in January that they said they're going to look at them like with a skeptical? I mean, you have to
it's the next one. So the November data.
Yeah, but we're going to get them in January. That's not what he was talking about, or he's talking about now?
He's saying now. He's saying the November data, because of the shutdown, they collected only half the data.
Yes.
So that's going to be skeptical. We're going to have to wait until January to get a real look at the data.
And then, assuming with 1 month worth of data, complete data, they're going to make a decision. I'm not sure about that. But we worry when that comes, okay? Let's see about today. Today was a good day, was a good pre-conference. The market liked it. Okay, we got good news across the board, okay? From growth to unemployment to all that. His tone, and I think the market does great from here.
Yeah. What about the data next week? Because everyone was pretty nervous about what's happening next week. Would that, based on what's said today, will next week be significant at all?
I think it will be. I think it will be, because it still gives you guidance, right? You still have an idea. And they're telling you already that the unemployment rate and the labor data, they are expecting it to come. Like whatever comes, they're expecting revisions to the downside. That was one of the dimensions. He is sort of like putting it down a bit, which is saying, look, like November probably not going to be as good. Even if it comes lower than expected or higher than expected, we're not going to take it as 100% face value. We have to wait until January in order to get that.
What he was saying basically is the data that we're getting next week, take them with a grain of salt.
But I think it still matters.
Yeah, they do matter, because the market are going to get them and they're going to take them and translate them to what, depending on what's happening on that day. But he was saying basically, we'll be a little bit skeptical about the data we're getting next week, because they are incomplete, they weren't like collected correctly, or whatever the case may be. So does that remove any reason for the market not to rally in December?
No. Like, unless something, because one of the important points was like at the beginning, he came in strong with a hold. You know what I mean? It was like the way that he answered the question was a little bit ambiguous, which was like, we still have time in order to make the decision. But the thing is the data will come and we'll try to make decisions based on that data. But he kind of like went back to data dependent, but he's like, look, we are okay where we are at right now. We are more in the neutral level unless something breaks to the downside. So if we start getting like surprises to the downside in unemployment, or not to upside unemployment or downside inflation, we can then vary it. But I think the problem here was he, in the meeting, made it seem that both mandates were still at phase at each other, but in the statement, unemployment was the higher.
We're going to finish the year with 4.5, which is higher, 0.1% higher than what we are now, 4.4, right? So unemployments keep climbing. But the way he answered the question, he was trying not to commit to a cut, because why would he do that?
Yeah.
You know what's going to happen. And that was the correct course, actually. Why to promise anything? You have to be in the middle of the pandemic to promise a cut for the next meeting. And we are not in the pandemic. We are like actually in a good place for the moment. So overall, I think this is great. This is great for the market. Now,
no, I think it is. I think the market came in this way more hawkish than it was.
Yes.
Like the market was expecting no more cuts. It's over. The market almost expected at like a couple of weeks ago, we were like, there's no way we get a cut. And Bank of America backtracked like a week ago.
Yeah.
That's what you follow and like the Market Buzz content, because we tell you what we really think, and we sometimes get it right. Most of the time we get it right.
Yeah. Get it right most of the times. So
exactly.
So, okay, so the Fed is out of the way. It's like, I'm not worried about the Fed in the next until the January meeting. So what is it that we worry that can derail the market from going up? And it's earnings.
It's earnings, but then that's January stuff, right? No?
Listen, if Oracle comes today and...
Oh, yes, that's something else that we have to talk about today. Oracle and the AI trade pumped today.
Fuck this up, like in a hurry.
Yeah, and Adobe too. Well, Adobe not so much. I think Oracle more.
Oracle is like one of the main players.
Yeah, for sure.
Oracle, like in a
Oracle is at 9. Yeah. No, Oracle is in the next 30 minutes. But Oracle pretty much gave away all of the earnings gain that it had since the last, and then some. Correct. And then we bounced sort of back, but not really.
Do you remember people buying the peak following the earnings?
Yeah,
like the stock went up 30% in a single day, and people bought the top.
yeah. I stayed away. Like, look at the volume. There was a lot of people buying.
Jesus.
You know what it was? This was the open deal, like the open AI deal, right? So they, like, I think because it was funny, they missed all of the metrics. They missed earnings, they missed revenue, and even though that happened, they still rallied, right? So this was interesting behavior, to say the least, right? Now, could we see them pick it back up here and then potentially continue to go up? Maybe.
They have, but they have to report like a strong beat and address the issues of people worrying about how they finance the capex.
Correct. Because the thing is a lot of people are putting a lot of eggs in the OpenAI basket, and with Gemini competing for users, and now
competing because some people saying that they are the big dog.
They are. They're finally ahead. Valuation is starting to say that. What did I say? Google was gonna be the AI race. We're gonna win the AI race.
How many?
I'm still backing that out.
How many is holding? Is it?
I'm okay. I'm just looking at crypto. Somebody just asked total crypto market wicked. Yeah, I mean, like I think crypto is going to take some time to react to all of that. I mean, at the very least, Russell 2000 is showing risk on sentiment. Very, very good. Very, very good. Crypto is waiting for Bitcoin to lead at the moment. It's trying to find a way. It's in a battle zone at the moment. I've been talking about the 94,000, 95,000. I said that Bitcoin will try to head towards 95,000 again, but it is a huge battle zone. So we just have to see how it'll. But overall, great. Overall, great.
Are you satisfied from tonight?
Yeah. It played out exactly how I thought it would, and I had discussions with other people about this. I'm going into this FOMC bullish, so yeah, really happy, really happy.
Yeah, it did two things. Not only did we get the neutral cut, but we got the catalyst out of the way, which cools markets. A lot of people were like the engagement on eToro told me that there were way too many people trying to pay attention to this release, right? I think we got over 200 votes, which, by the way, thank you so much, everybody that was watching. Thanks so much for staying in the chat. Massive love to you guys. But yeah, like this was the interesting part. It was like so many people were looking at this, just waiting for something. And then we got it. Okay, everything is calm. It's nothing major. We don't have to worry about. This alleviates a lot of the pressure that we've been having. Next pressure we have to face is the data, right? The next data reads that we're going to get, obviously a couple of the earnings that are going to be live. But again, this cements the idea of a potential end of the year rally, unless the only thing I would say, because this is always in the back of my mind, the Trump factor. Don't wait for Trump to freaking mess it up at any point. So this can happen. Don't worry. If you subscribe, we're going to go into a live emergency broadcast mode. So we're also going live tomorrow, which is nice.
I think Trump only fucked this up if he announces new tariffs.
Tariffs, China tensions. But so far, everything seems to be cooling off, right? NVIDIA is going to be able to ship the H200s. China says it's going to limit the amount. I think Ford just got a couple of the Ford suppliers got a couple of the licenses to the rare earth minerals from China. So this is all good news, and it shows easing tensions, at least in the China-US trade war, which is fantastic news. Also something to be sort of happy about, because that was super interesting. Also, one of the comments that Jerome said was like, look, like if we don't get any more tariffs, like this is great. You know what I mean? Like this is fantastic, because it's like it takes time. The problem was we could have had this cuts way sooner if Trump didn't decide to shake the economy, because the Fed has to see how the economy is going to react.
No, he didn't say that. He said that the inflation would be lower if Trump was, and the assumption is that they will cut like earlier, which might be the case. But okay, so but in the end, it worked out pretty well. No.
Yeah.
The market is having a great year. It's been having like 3 straight good years in this late boom market. Okay, crypto hasn't been working according to plan this year, but everything else works on point. I don't buy that thing that it takes 9 months for the tariffs to show up on inflation, and then the traditional inflation thing like had me thinking like, okay, so now we're separating the two kinds of inflation, traditional inflation and tariffs inflation. So now we're categorizing the inflation in 2 camps. I mean, I don't know what to say about that, but I guess it is what it is.
No, the thing is what he was saying is that services inflation is actually coming down, right? But goods inflation is showing up where the tariffs are in. So they're directly related to the increase in prices that we've seen from materials coming into the country, right? So that's supposed to sort of alleviate. Now, the scary part that they did not talk about, which has me a little bit scared, is that most retailers have taken it in the margin. So goods inflation has been the one that's been rising, but also because there's no pricing power from many people. So that's also something we have to take into consideration as well. Could we continue to see? I mean, like the thing is like we are like I think it was like what, middle of September, October, when we finally are like, okay, we know what the tariff implications are, because they've changed so much. Like they keep getting delayed, they keep getting pushed, they keep getting moved, we still don't know how to impose them, implement them. So they've actually made some money on the tariffs, but we still like it's still gonna take a little bit of time for everybody to kind of price them in. And we also saw that increase in imports from all of the products and all of the things. I think tomorrow we get the trade balance, and it's actually coming down now. So we're gonna see it.
Or maybe he was scapegoating with Trump. Used Trump as a scapegoat to someone to blame for inflation. Because they can't predict exactly what the inflation are from tariffs, and Trump was there for the taking.
Well, after all the pile of stuff that Trump has thrown at Jerome.
Yeah, he had the right to do that.
You know what I mean? Like, and he didn't even do it that bad. You know, he does it with style. You know, it's like I'm just gonna, you know, like this could have been better. But like I agree with the fact that he's been doing his job. You know what I mean? Like he's like I don't see the political in Powell so far. I have not seen it. Whether it's for one way or another, I haven't seen it. Like
so what he did that made him look political is doing the first cut last year before the election.
Yeah,
that was what made him like look political. If he is or not, I think he did a good job as the Fed chair, considering the pandemic and all that. He has been like a good chair, and we're gonna have to see what the next guy looks like, and if the next guy can stand like that in front of the press and answer every single question without losing his cool and without the I don't know, let me see and all that.
Yeah.
You don't want to be in a market where the Fed doesn't know how to answer questions.
Yeah. Kind of gonna miss Powell, but
yeah.
I'm gonna miss Powell.
Yeah.
Give him the Nobel. People are like, there's like conspiracy theories around him. There's like that he's messing up? I don't think so, man. I don't know. Like, he still has ammunition. If shit hits the fan, he still has the ammunition to manage it. I'm like, I'm like, it's like, so far it's been, I didn't want no cuts. This year. I was like, you know what? If we need to see stuff burn, let it burn for a little bit. Let's see what's up. Let's see what works. Let's see what doesn't. And we've gotten some cuts. Okay, we have alleviated. Even if we don't get cuts in January, which I don't think is the case, because I think they're going to lean towards the cuts. But I don't want them. Yeah, I mean, I'm like, but, well, yeah, I had a question. Like, if I could ask him a question, I would have loved to sort of get an idea of how the thing is like, I don't think he can answer this, because he's not going to like talk about other monetary policy from other governments and stuff. But how does the Japanese, like, how is the Japanese interest rate affecting his decision making, and how is that affecting the liquidity of the economy? I'm telling you, Dimitri, I'm telling you. He can't answer it, but I would love to. Like, go after, be like, hey, Jerome, can I talk to you for a bit? Like, yo, what do you think about this? Like, under the radar,
He's having a hard time getting data within his own country and making a decision, right?
Imagine in Japanese, yeah.
I don't look the Japanese. It doesn't make any sense there.
Yeah. Oh, for sure.
No, but you know what? I'm going to bed tonight feeling better. Not that I was stressing before, but you have this thing, you have to get it out of the way, and sometimes the Q&A can get tricky, and ask him like a question and then answering the wrong way. But he was on point today, and I don't see any reason why the market doesn't rally. Then we get the data next week, and if they are around the estimates, like on expectations, then we have a strong end of the year. What's that?
This has gone up. So this is the probability that we get a cut next month in January. Yeah.
What's the number? 21?
24.
24.
And we were sitting at 20 just before the Fed meeting. So there is a little bit of this. This was taking a little bit neutral dovish by the market so far. No, I'm not super dovish, but just like neutral dovish, just because the market. Okay, let's see the data and see what's up.
Yeah.
Okay.
Nice.
Guys, I need to go. I am I'm slowly fading. I can't even. Okay.
So what happens probably, you're going to try to get to sleep. And
the sun's going to come up soon, actually. I'm terrified.
Crypto's going to rally, and then you're going to wake up and you're not going to sleep tonight.
Well, that was worth it. That was actually worth it. Yeah.
I'll put you in the back. Maybe.
Okay. What do you? Do I need a? Okay.
That's the thing. I'm not sure because I don't know if it will upload or not. But
let's see what happens. Thank you. Talk to you guys.
Good night.
Bye.
So yes, now we have the Oracle. I just want to get the numbers just to get an idea that Oracle is not going to implode tomorrow and this could crash the markets. We're going to be calling Meme. Oh man. We're going to be like, hey. Oh man. Because that's the thing. So Oracle is an AI, like it's the leverage AI play or the leverage data center play, which could have its implications here. By the way, if you have any questions, don't forget to put them in the chat. We're more than happy to try to answer them. Give your advice. Oh, there we go.
How's the market doing? Put the
it's going on. The S&P,
yeah.
S&P 500.
Microsoft.
I mean, like, Microsoft is down.
Why is that?
I wonder why. Let me have a look. I'll tell you. It's a wait and see. We're more than happy to wait and see.
So so let's make a call here. Do you predict a January cut?
Yeah.
Okay.
Like if we continue to see employment how it's been behaving, yes.
With the data that we have today,
yeah.
And we get one.
I think we get deterioration on the employment market. I think right now I'm bearish in I think employment is taking a hit. Yeah. You know, and I think it's gonna potentially bounce back, but it's gonna take a while. Because you don't usually have when do companies usually hire? Not December.
No, December is holiday season. Nobody's
You know what I mean? Like nobody's working.
And nobody's firing either in December. Exactly. Nobody's hiring and nobody's firing any people in December. So December, whatever it was in November, probably it's gonna finish. Probably a bit more hiring because the seasonals. There's gonna be some hiring in December. You know, like in the hospitality, they might have some more seasonal people. But in general, people don't get hired in December or fired. It's just wrong to fire people in December.
So that's the thing, you know. And then January it's gonna be tricky. The thing is like if they hold in January, the thing is you don't want to like start and go. You know what I mean? So it's like if you're gonna cut in January and then stop, you know, because if all of a sudden you're like and then you start sort of messing up with the perception of
but this is a new but they finish the year with 3 cuts and then they start in the new year. It's like a clean slate, and then it's not like the last 4 meetings of the year we're going to cut 4 times. It's like a new year. It's a new set of realities. That's why my thing is I don't think we're getting a cut in January, but we're going to get more cuts than the market is pricing for 2026. I'm sticking to that.
So no, for 2026, I think it's more than 2 cuts for sure.
I think it's 3. I think it's 3 plus.
Yeah, I'm okay with 3 plus. I like 3 plus.
3 plus.
Potential of 4. Yeah. Or emergency cuts.
No, you don't want to go. You don't want to go there. Those are never good. Emergency are never like. If the Fed is doing emergency, it means it's a shit show already.
Yeah. It's somebody's gonna go bankrupt quick.
Yeah. You don't want to go there. I prefer the slow and steady, like. And you know what? And another thing you have to take into consideration about the stop and go that you just mentioned. If they give a cut from the get-go, then what? They're gonna cut,
expect it.
Then pause, then cut, then pause. So the wait and see, the way I took it, is we're probably not gonna cut the first couple of meetings, and then the end of the year is going to be all the cuts are going to come together as low, because at the same time they have to let inflation get a bit further down so they can keep that neutral like range, like grow a little bit, so give them some room to cut. So if I have to guess, we are not getting a January cut. Is it a way to bet on this?
Yeah, Polymarket.
Polymarket.
Show me. Let's have a look at what Polymarket says.
Yes.
Look. He said inflation 60 times in review, but yeah, he said it. Inflation 60 plus times. Dude, they bet on everything. It's crazy. Weakening, you know, like what he's gonna say. Did you hear what there was a CEO that apparently went in and like, so they were doing the earnings call, and there was like bets on what he would say, and somebody at the end gave him a note of all of the words that they were meant to say, and they grabbed it and just said, "To the moon, coin, market cap," and then he freaking read them. It's crazy. Apparently, and I heard there was a story about that. Something to dig a little bit deeper. But yeah, I mean, that you can bet on anything right now. Like, who do you think that the 2025 person of the year is in time? People are saying 56% AI.
It's not a person. Maybe it's like
Sam Altman.
Jensen Huang.
Yeah. Okay, look at this. Jensen, maybe. Jensen, they were voting for Jensen. Jensen had a lot too. But look at this. No change. It's at 80% right now. 25 basis points, 19, and then increase or decrease more, it's 1% or 1%.
I would go with a no change. How much?
You would make, like, if you go in for a yes, it's like if you put, let's say you do
€100.
100. I think, I'm not sure. I actually have no idea how this works. Because you buy shares. So you would make, if you buy 100 shares, you would make, how does this work?
I have to look into this.
So it's like you would put $80 and you would win 100. So you would make 20%. It's
Okay.
interesting. It's interesting because the way that they were, do you know the compound?
Yeah.
Josh Brown?
Yeah.
Yeah, they were talking about it, and it was like, it's like, if you tell me, like, you know, it's like you have to put in X amount of money to make this much, right? Like, it's like if you put in X amount to make $20, it's not a lot. But it's like if the rate cut is pretty much set in stone, which I actually disagree with this. I would actually bet, like, I think these numbers are wrong. I would say that these are wrong. I think there's more chance of a cut than not a cut because we haven't gotten the data.
Those they change though. Those numbers
Every day. Exactly. So every day as the data starts coming out, you can bet, and then you can sell it. You can sell your position right after. So let's say, for example, you go here and then you put in $100. It would cost you $19, but you could make 100.
Like options?
It's not like options, but it's like trading the decision as the data and the people buy and sell.
Mm.
You know? And yeah, and then March, no change. He's sitting at 55, and then 25 basis points is at 42. Interesting. So you see, there's discrepancy on what the market believes. 41. That's a cut right here. So I think this went up. Yeah, this went up. Look at this. A day ago, it was 33. So we are getting a cut, whether it's in January or in. Because it's interesting. One of the things you said, people don't fire anybody in December.
Mm-hmm.
So I mean, we might not see that much unemployment rises, and then wait until January, we start seeing layoffs. Interesting, but yeah, you can bet on here. You can bet a bunch of things.
Give me something else. Give me something funny.
This one, Jake Paul versus Anthony Joshua. Who do you think is gonna win? It's gonna be so good. It's gonna be so good.
Anthony Joshua, 87%. Jake Paul, 8%.
Yeah. Yeah. It's gonna be interesting. Yeah, it's gonna be very interesting to see. But yeah, this is gonna be because I think Joshua is like in his prime still. Like he not in his. Like, I think he's a bit older, but he's still.
No, Joshua. He used to be like the heavyweight champion of the world, and he's fighting like an amateur.
Yeah. But he sells tickets. The thing is,
but he compared to Joshua, he's an amateur. Even though he has some fights, it's like they're not like on the same level.
Yeah, for sure. Look at this. This is the Venezuelan engagement. It's a 72% chance of no.
Is pre-market going public?
I think Kelshi is offering because there's two betting sites. So then there's this one, and then there's Kelsh.
I think Polymarket got on Robinhood.
No, I think I'm not sure. I think it's Kelshi. I'm not really sure. This is the other one. Ugh. Why a white background? This is awful. Ugh. Ugh.
How long for the Oracle data?
6 minutes.
Let me go to the bathroom 1 minute.
Okay. Ooh,
I'm interested because we have to get that out of the way as well.
I think so too.
We don't want anything hanging above the AI story.
Yeah, look at this. The betting markets.
The S&P is on pace for a rebel close.
Is it sitting at all-time highs? Oracle beat quarterly earnings? I think this is right. Whoa! What happened? What happened there?
What are you talking about?
So this is the Adobe. Adobe was sitting at almost 96% chance of beating. And just now, bam, 53% chance.
Someone knows something.
Someone knows something here.
How much are you? How much up are you on Adobe? Like 5-6%?
Let's have a look. Let me have a look.
How many views, by the way, for the video today?
Quite a few. We have 10 people still watching us, which thank you very much. You guys are the real MVPs.
Thank you, guys. I hope we'll keep it interesting.
The Adobe.
344 for Oracle. Yeah, Oracle got crazy following the
hope and dreams. Oh no! Sorry, that was Adobe.
Okay.
Yeah, Adobe right now is sitting at. Let's have a look. Adobe is sitting at 344 right now. I'm up 6.2% on that trade, and then I'm up 100% on the calls. But this freaks me out. Who knows? Who knows this? You know. Let's look at the order book. You know what it is? Is that people don't want to. So the ask is sitting at 90, but the bids are like, I'll give you 50 cents.
Okay, so Adobe, if they don't bid, I get it. You are not you're going to take a hit, but the big picture doesn't affect the AI story, but Oracle does.
Mm-hmm.
So I hope they got their act together, because the stock it's been going down.
Look, bam, bam, bam. But it's Oracle is saying like they're at 90.
Okay.
Right. The market
market closed?
The market on close. No. We have 2 minutes until the market close. Netflix is finding buyers. The S&P 500 is 3 billion to the sell side, 2 billion to the buy side. The Nasdaq is 100 million to the sell side, 800 million to the buy side. The Dow is 900 million to the sell side and 300 million to the downside to the buy side. The Mag 7 is 300 million to the buy side. So the Mag 7 are getting bought into the close. All right, and then we're gonna pay attention to double check.
JPM is up 3.1%. Uber is down 6%. Oh wow.
Yeah, I don't understand why. I need to do the research on them. That looks interesting. It looks like the JP Morgan drop.
Uber and Microsoft. Okay, that's a weird combination.
Let me have a look here. Trump says that the rate should be the lowest in the world.
Of course you did. I expected nothing less.
Nothing. You can't. It's Trump. Markets are selling off a little bit. All right. So let's go to the 1 minute. I don't even know if we can go to the 15 minutes. So here we have the oracles. Here we have the Oracle. So we're seeing quite a bit of selling pressure here. Market close.
The
So
Dow.
we're expecting $1.68 earnings per share and 16.2 billion.
So we have.
So this is Oracle right here. Bam, bam. And then we can put Adobe.
What time the report? The report at the close?
Yeah, 5 minutes after the close.
Okay.
Is what we're expecting. So then can I change the settings, visibility?
What's that noise?
It's probably me moving the mic.
Okay.
Does it still sound?
Yeah.
Is it gone?
Yeah.
Nice. Yeah, it's whenever I move the mic too much. Let's go to the 5 minutes.
Do you have a
So
stake? Do you have a stake in Oracle or no?
No. I'm not trading Oracle. I'm trading Adobe. Because Adobe is being so punished, right? Like Oracle is still dodgy. I don't know. Like it could be and go up. I'm not against them, but let me see the data. Man, market sold off a little bit into the close, but it's okay.
No, whatever, like on the Fed day, whatever happens, happens. Don't take them very seriously.
Yeah, we still have to see how they're going to digest that data tomorrow anyways.
Yes, tomorrow is where the game is. The day of the Fed, whatever happens, happens. But overall, we had like was a good night.
Yeah. So if we go to 230, so we go right there. So Oracle is up 1.24% today, and Adobe is up 0.5%. We get the data here real quick. I have the Adobe data I'm waiting on, and then whoop. Nope. Whoop. So Adobe moving. Why am I doing? I can check this. I can check it here. Let me have a look. Adobe. All right. Adobe's up a little bit. It found strength because of the Fed. Let me have a look. And then let me have a look at Oracle. ORCL. Damn, it's Oracle is bouncing off the 50 MA.
It would be great to have a good beat and give a strong outlook.
Yeah. Just give me, be like the outlook. We continue to strengthen the outlook
of
sales. NVIDIA would rally. Oh. Crap. Nothing happened. What? Oh.
Give it another 2 minutes.
Oracle's up. Oracle likes it. Adobe likes it. Let's go.
Let's go.
A miss on revenue.
Oh, great.
EPS $2.26.
Above?
That's a 64-cent beat. But Adobe likes it. Ooh. Oracle doesn't like that. They missed on cloud. They missed on cloud.
Oh my God. Missed on cloud.
So they beat on EPS, but they missed on revenue. They're not. This is not going to be like.
Nobody else missed on cloud this earnings season. In fact, Amazon, Google, and Microsoft reported better than expected on cloud, if I remember correctly.
And
right?
Adobe, yeah, I think so. And then Adobe beat estimates. Let's have a look. So Adobe was waiting 6.11. They beat estimates 6.19. And then earnings per share, they were expecting 5.39. They got 5.5. So Adobe beats. That's why it's a little bit higher. But Oracle does not like the news that they missed on. I told you. It's like, so, all right, let me go over this. It's a fair mind. Oracle up, and it's gone. Antonio! All right, so Adobe's up. Adobe's actually in line a little bit higher. Yeah, Oracle is down 5.5%. So
Great.
adjusted EPS was expected to come in at 1.64. It came in at 2.26. So they cut a lot of costs, it seems. So earnings were higher than expected. Revenue is a miss at 16.21 billion. The actual was 16.06. Adjusted operating income was estimated to be 6.82. It came in at 6.72. Operating margins came in a little bit under, which was a 42.2. It came in at 42. Tiny miss there. Software revenue misses 5.88. Estimated was 6 billion. Cloud infrastructure was expected to come at 4.09. It came in at 4.1. So that's like in line with expectations. Cloud application revenue came in line, and performance obligations, remaining performance obligations. Oh, okay. No, 523 billion versus 97 billion last year. Stock doesn't like this. Adobe's up 2%. Let's go. We take the dubs. Holy. So yeah, Oracle doesn't like this. Like Oracle is like, but the thing is like they're expecting that revenue to come in next year. So the fact that they are like cutting in costs in order to sort of like maybe trim the, but then gross margins didn't come in. Operating margins didn't come in that much. Interesting. It's an interesting result. We'll have to see what they say in the call.
Give me the longer.
The long frame?
Yeah, give me the year.
Yeah, we'll do.
I want to see in a year to get like.
So if we go to the, let's go.
Hey, so we have to go how long back to get this low?
So we were here. We're coming in here. 17% down. Right now we're sitting at around 6% down. Core weave is lower too.
Since July?
What's NVIDIA doing? I would imagine NVIDIA doesn't like this either.
Why? NVIDIA, they're like in their own league.
Yes and no, because they're selling they're selling to the hyperscalers. So if we actually look here, so we go to after hours. Yeah, there we go. NVIDIA doesn't like this one bit because they're selling to the hyperscalers, right?
No, I think everything is down. This is just a normal, like after like a rally and the market closing at the...
No, I think it's because we also have core weave down. Look at this. Core weave is down almost. It was already down 2% today, and now it's another 4. So it's 4.5% down on the day.
What it would take for you to buy Oracle?
So much.
What do you mean so much?
Yeah, like they would have to like show me proof that they are actually going to be renting out the massive debt and expenses that they have. Cut down expenses, trim down the operation, right? Like,
okay, so the market is pricing that as we speak.
Yeah.
Right, and assuming they're gonna have
they need to show revenues. If they start showing the revenues coming,
which they're gonna get them supposedly next year.
Yeah.
So how much lower the stock has to go to remove the risk, and you feeling comfortable taking a 3% position, not leverage, just
for me to even consider Oracle?
Yeah.
Let me have a look. Yeah, I look at JP Morgan today. What a beautiful. I bought a 300 yesterday. I just put a buy order at a cheeky 300. It's a 3% give. Thank you, market. Here. My friend, he posts Oracle up, and it is gone. So Oracle right now is sitting at what? It's sitting at a 51 PE, going to 27.
27 is not ridiculously high.
Yeah, but this is expected on everything going to plan with AI. This is OpenAI getting the money. You know what I mean?
Yeah.
So for me, 20% drop from here.
Another 20%.
Like
that could happen like in a hurry.
Yeah, like 150, 140.
What is now?
210.
140, 150. Okay, 150. 50% down from the top. Yeah, more than 50. I'd take.
They missed.
I'd take
They
it.
missed twice. You know what I mean? Like they're not delivering.
Yeah, but the EPS came. The EPS beat this time, right?
EPS beat drastically.
Yeah, but that means revenue. Okay. Yeah.
Yeah, but they're not growing revenues, right? So it's like, okay, like you're cutting expenses, great. Show me you can beat. You know, like why is your revenue not beating? They missed last time. They missed this time.
You know what? I think we're going to be able to get it 140, 150.
Maybe. I mean, like the thing, the question is like, what else could you get if you see that decrease? We could see Nvidia 160, 140, right? Because the thing is, like Nvidia has to do with the hyperscalers.
No, it's not the same.
It's the same. It's the same. They're correlated.
Okay, but if Nvidia take that drop, is like a different magnitude of a move than Oracle.
No. It wouldn't be the same. It wouldn't be the same.
Nobody's losing sleep tonight because of Oracle.
Look at this. Selena is like, I bought it. I bought the dip. Like if they do, if they actually build their revenues into next year, great, fantastic, you know. But right now, the reason they went up was because of the OpenAI deals. And sorry, like if it was like an Nvidia deal, a Microsoft deal, give me whoever you want deal, except for OpenAI, which right now is like burning cash. I don't trust their revenues. Their models is not competitive right now.
Questionable source of where they're getting their money. Are they like circling them around between them? Yeah. I'm just trying to figure out like what it would take for me to take a stake on it.
On Oracle?
Yeah, because it's not going to get any safer until the next earnings call that they're going to give us some.
And it's Q2 2026. It's not Q1 2026. It's Q2. So this is expected to continue to go on until they can prove. Like look at expectations. So if we go to financials here, right, and then we go to like, we're expecting 10% beat. Well, this is a massive beat, so it's going to be pretty big. But then it's like 4%, 5%, and then revenues 16, 19. But this needs to go way higher. Like they need to go up. It becomes tricky. It's like the data centers. I don't think the data centers are going to be where it's a massive investment to come up with your own model. I don't think like it's running the models and like running the infrastructure and all that stuff. So it's like, I don't know. I like the thing is like, you asked me what it would take. Like everything would have to stay the same and Oracle drop another 10, 15%, but everything else has to stay the same, because if everything else drops, then everything else becomes more competitive. Like right now, I just think they're a better option. I could be wrong though, Selena, so don't listen to me. You know what I mean? I have not paid attention to Oracle. Something to take in mind, Ooh, Adobe's taking a hit.
I would take a stake if all the bad news are priced in and all the risk has been removed. And the 140, 150, a good level for me to enter. Like if I'm gonna buy like a chunk of it. I'm not gonna buy like 1%. I'm gonna buy like a sizable position. But again, how much tech do you want to have within a portfolio?
You know who benefits from the news that we just got?
What?
Adobe. Because they're making this massive infrastructure build out and they're going to have to rent it out. And if nobody wants to rent it out, they're going to be able to rent it out to the software companies that don't have to make the build out. They're going to be able to get cheap compute because they're going to compete with each other. And then you don't even need to build your own infrastructure. You just rent it out at the beginning. I like Adobe to the moon, even though I'm losing money. Adobe to the moon.
Is anybody else reports today, or that was it?
No, I think that's it. I think those were the big ones. Let me have a look. I think Synopsys, not really sure. Ooh, they're up. And then Planet Labs, BBC.
Is that Broadcom?
Broadcom is tomorrow.
Oh, okay. Wait, when do the bank report? The banks?
No, we still have time. I think isn't it January, February? Because we have Nike, FedEx, Micron. There we go.
There you go.
January 14th.
Okay, so in a month.
Earnings season begins. So there's still time, right?
Yeah.
There's still time. Yeah. Oh, Adobe forecast annual revenue above estimates. Let's go. Adobe should. The thing is like the AI market is not gonna like this because it's taking forever. And right now it's like, okay, everybody's spending, but no money's coming in. Why no money's coming in? That's what people are scared here.
Yeah, and then in some point they are gonna say, you know what? We spend enough money. We want to see some return on that money. Let's slow down the capex. The market is going to assume the worst, and there will be a repricing of the AI trade.
Yeah.
You don't want to be holding too much AI at that point.
You know when Meta went up, and Meta recently went up like 4 or 5%.
Yeah.
And it was because they said they were going to cut spending on
on the
metaverse.
The metaverse, which they should have done like a long time ago.
What if everybody's starting to get like what if you start getting rewarded because it was like the more you spend, the more we'll reward you. Now you're spending too much. What if you decide, hey, let's cut spending a little bit, and then the companies are like, well done, keep on the cash flow. Let's just spend cash flow. Let's not go into debt. Right? Because that's what people are like. That's what Meta is getting punished. That's why Amazon's getting punished because they're going into debt.
Yeah, but Meta is like different because they were spending money or something ridiculous.
Correct.
Which is the metaverse. The AI is completely different story. But all the big players are spending like 60, 70, 100 billion a piece. And they have to see some return on that.
But the build out is going to take forever. The problem is the build out is going to take like a data center takes 1 to 3 years to build out. Even the fastest one will take a year. And even then, it's like you're building from scratch. So I think the build out we're just early innings.
Yeah, but if the market starts selling your stock because you're spending too much money and they force you into slow down the capex, I think the hyperscalers will stop the capex spending on a dime.
Yeah.
If their bottom line start getting affected.
Like what's the worst case scenario, right? Like I think for Meta, for example, every 4 years they can withdraw from the deal. It'll cost the money, but it's like they can take 1 quarter of bad earnings.
Okay, so what happens if Amazon goes from 100 billion to 50 billion?
In a spending?
Yeah.
Nvidia drops drastically. That's the problem. Nvidia, the problem with Nvidia that it's like, like when you look at Costco, the price to sales is 1.4, right? They sell a lot, right? So it's like, even if you lose 1 customer, 2 customers, okay. If Nvidia loses one of the big customers, it's a massive hit to silicon. So that's where it's like, when you look at Nvidia's valuation, Nvidia is expensive on the fact that they need to continue to sell these chips. If they slow down, if the AI story slow down at any point, it causes a massive downside risk for Nvidia, because then it's like it's a direct impact to revenue and to earnings per share.
And their largest customers, they can't wait to get out of Nvidia and have their own chips.
They're trying. Well, Google already has. Like Google's already out. Amazon is already sort of out. They are spending the money in order to try to get out.
They're trying to get them up and running, but they're not up. But Google, I think they can do without them.
I think the Gemini model was run on TPUs alone. So at least that's the rumor.
That was a good call by you, by the way, to 160. You called it.
Yeah, it was. Look, it was a friend of mine, Antonio. This guy, Antonio. He called me while I was like cleaning my porch, and he was like, "Yo, Google is down again." And I was like, and then I bought some. I was like, I'm gonna buy it just to mess with him. I was like, I'm gonna buy it. And then the moment you buy a stock, even if it's $1, the moment you buy, you're like, let me. Every time the name comes up, you're like, let's do the research.
Yes,
it's like playing poker with money or without. And then I started paying attention, and I was like, whoa, there's a ton of value here, like a ton. And then everybody's narrating, no, because AI is going to steal Google's search revenue, and that's Google is over. And I was like, this is so wrong. This is so wrong. Like, I was like, I am willing to bet a lot. It was my second biggest position after Nvidia. It's crazy. At some point, when we had the latest rally, it surpassed my Google position, surpassed my Nvidia position in value, just from the moves that it was having. It was crazy.
I think for me too on the Ether portfolio.
Then it came back down, everything, but
Google now is my largest position.
Yeah, no, Google is my second, but it's close. It's close. But yeah, all right. I think we're good, unless we want to stay for the call, which
no, let's go.
All right.
Yeah, long day.
Yeah, guys, thanks so much for watching. I really appreciate you. Don't forget to check out the comments down below. I'm going to fix Timothy's link for the altcoin course, free of charge for those Market Buzz participants. Thanks so much for watching, guys. Thanks so much for staying with us. We really appreciate you.
We're going live tomorrow.
Antonio. We're also going live at 1:30, so don't forget to hit that like and subscribe. We're 529 subscribers. I don't know. I think we have one more, but I need to refresh the page.
Let's fucking go.
Let's go to the moon. Market Buzz to the moon. 533. Let's go.
Oh,
to the moon. All right. Let's go. Market Buzz to the moon.
Toby stick.
Toby
stayed through the whole.
He stayed with us the whole time.
Yes.
He's still sweating Jerome's words. He's like, interest rate cuts.
I have a feeling that Toby's gonna buy us drinks next time we see him.
I think so too.
We made a bet.
Yeah. He's been to the chat. There's no way of getting away from it. All right, guys. Thanks so much for watching, guys. Everybody, thanks for them over 100 messages in the chats. Whew, you guys keep it entertaining, and we do it just because we enjoy it. Thanks so much for watching, everybody. Peace. Yo, Adobe beats estimates Q4 strong adoption. Let's go. Tomorrow's Adobe pumps.
Good night, Selena.
Good night, Selena. Thanks so much for staying till the end. Yo, I met you, Mott. Welcome to the Mott team. Getting free labor from eToro Popular Investors. Let's go.
Let's go.
Thanks so much for watching, everybody. Whew. Stop sharing. Peace.